This week, we are coming out with two interesting webinars. The first webinar is The Secret to Long-Term Wealth, where we discuss on the behavioral aspect for long-term wealth generation. And the second webinar is The Impact of Tariff in Indian Stock Market, where we discuss the current issue of US-India tariff situation. To join this webinar, click the link below.
Welcome to the September 2025 Fixed Income Outlook. This time we're talking about how debt is coming back into fashion. If we look at how investors have positioned their portfolios, there's a lot more interest towards fixed income at this point in time. What we've actually seen despite a year of rate cuts is that yields on the long end have gone up, and this has really taken away some of the investor appetite to make returns on fixed income. So with a few shifts that have happened both in tone and in terms of data, we are seeing a renewed interest in this asset class, and it's a great time to play a safe investment for your portfolio. So let's get into some of the data points that we're going to analyze. We're predominantly going to look at Q1 GDP data, what the Monetary Policy Committee had to say, and why all eyes are on the Fed at this point in time. So let's start with Q1 GDP data. Q1 GDP growth came in at 7.8%, much above the RBI's expectation of 6.5%, and this was a welcome data point for a lot of market participants. Yet there were a few voices that said that we need to really look at these data points because firstly, government capex in the first quarter has been higher this year compared to last year, but also a lot of tariff-related headlines have driven economic activity into Q1 because there was a lot of uncertainty as what would play out in Q2. When we look at whether this actually makes sense or not, we're trying to study data points like what's going on in your PMI in terms of manufacturing and services. And here the data tells us that economic activity is more broad-based. It's not solely export-oriented. So there is some truth to the growth that's occurring on the ground. It's not just about front-loading orders. And when it comes to government capex, last year was an election year, which severely constrained how much the government could spend, and this year is not. So a higher spending in Q1 is not necessarily a red flag that we need to watch out for. That being said, the economy still needs a lot of support. There is a significant amount of global uncertainty. And this brings us to our second data point that we're looking at, which is commentary from the committee members. So when we look at what the RBI committee deliberated on and what was on their mind in their August policy review, what becomes clear is that many of the committee members felt that it was difficult not to cut rates at this point. The economy did need support for growth, and there was a lot of uncertainty in the outlook, as well as many central banks outside of India, including the Fed, were yet to sort of decide on their course of monetary policy action. So too much too soon from the RBI might limit their options in the future, and preserving optionality was one of the committee's priorities. If we move even further into the data, a lot of them acknowledge that there is room to cut rates based on the inflation forecast because inflation numbers are going down. What kept them a little bit on edge and worried about where inflation was heading was the fact that core inflation remained to be around 4%, which is our long-term target. Whereas the target is actually for headline inflation, which has been cooling significantly because vegetable prices coming off. Now, this brings us to the third action point, which is in terms of the Fed. All eyes are on what the Fed will do this month, primarily because there was very early signaling from the chairman at the Jackson Hole Symposium saying that the Fed has kept policy tight and there is room to sort of ease policy, indicating that rate cuts could happen as early as September. This is very much in line with what the Fed has been saying throughout the year, but a signal for rate cuts has actually given markets a little bit more room to breathe and figure out where we're going from here. But more importantly, this is also a meeting where the Fed will release something known as a summary of economic projections, or more popularly known as the dot plot. This gives us some insight into how the Fed is looking at the path of interest rates. So it's not just about what's going to happen in September, but in the months to come as well. This path can give us some guidance as to how deep of an economic problem the Fed is seeing at the moment. So what we want to look at is how persistent inflation is, whether growth is actually more sluggish than before or not. Remember that in the past summary of economic projections, the Fed has been consistently cutting its growth forecast. And lastly, we want to see where unemployment lands, because we are seeing an uptick in unemployment. But this doesn't necessarily mean anything bad, because the Fed seems to have some level of tolerance for unemployment. But one thing we need to keep in mind is that unemployment tends to peak towards the end of a recession and not at the start of a recession. So keeping this in mind, we really need to watch out for the Fed's language and what they have in store for markets in the coming quarters. So to conclude, yields in India have expanded over the last couple of months, and this gives a lot of investors a great re-entry opportunity. So if you've missed out on the debt rally so far, then it's a good time to look at adding some fixed income to your asset allocation. And more importantly, with so much global uncertainty, don't you want to play it a little safer with your investments? If you're ready to make a safe investment, or if you want to know more about how you can structure your investments, then reach out to us at 9500027285, and we'll be very happy to help you with your next investment decision.